Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, June 5th, just after the close. Headlines, headlines, headlines. All important, correct? No! We've discussed this for 12 months or 18 months now. It's how traders and investors are positioned going into those headlines. As we saw today, horrible numbers in terms of unemployment taken by itself. But when compared to what was expected, you saw the reaction in the market, both fixed income and equity. 10-year Treasury trading through 90 basis points today, as high as 92, 93 basis points, closed right at 90. Patty Healy, Senior Vice President of Research in our bond department, is going to touch on that in a little while, filling in for John Musso today. Let's get over to the equity side of the equation. As that continues to have a bid that makes me shake my head and get dizzy at times. As we rally here in multiple areas, you've seen a change in allocation. Let's take a look at the year-to-date chart of different styles, different market caps. You can see when we take a peek at that, large cap growth right up top, outperforming the S&P by 9, almost 10% after today. Keep in mind, these charts are at Thursday's close. Followed up by momentum, outperforming S&P. Those are the areas you've wanted to be in year to date. Very solid performance. Look at the bottom of that chart. Old IJR. The ugly stepchild, small cap. Can't get out of its own way. We know that. We know mid-cap can barely get out of its own way. It's been a drag on any investor's strategic allocation. Anything away from large cap growth has been a weight on your net return. Starting to change now. Let's take a look at the 30-day. This is a real divergent move here. You notice IJR up almost 10% through that today versus the S&P. Again, we're not looking at net returns. IJR, that 9.55 you're looking at, that's not a net return. That's versus the S&P. We're just trying to look at relative strength. What's working here? Mid-cap, right behind it, as represented by IJH. These are ETFs that I'm mentioning. Very solid 30-day moves. Rare to see that kind of move in 30 days versus the S&P. Now, one thing we're going to have to really pay attention to on a weekly basis is, does this relative strength continue? We've had head fakes in the past. Over the last 2 or 3 years, there have been months and there have been occasional quarters where mid-cap, not so much small cap, but mid-cap showed outstanding performance versus the S&P, but it could never follow through. The granddaddy, S&P, would come storming back and pull all allocation money, all new money, into that index. Let's see if we get any legs here. If banks can keep strength, if industrials can keep strong, if energy can keep a bid, these are the type of names that are populated in value indexes, in small cap indexes, in mid cap indexes. So going forward, we're going to look to see, does that spread of mid cap and small cap versus S&P stay solid? Does it expand, or does it start to contract? That will dictate positioning for us across all of our equity strategies. Have a great weekend. We'll speak again next Friday.
Hi, I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors. I'm filling in today for John Musso, who's on a really well-deserved vacation, although he is working a bit today. So the big news today was the jobs report. The increase in employment was 2.5 million, and this was compared to expectations of 7.5 million in decline in jobs. So this brought the unemployment rate to 13%, where it had been projected to maybe be 19%. Treasury yields had been creeping up a little bit over the week, maybe in anticipation of more positive news. Even though the numbers were projected to be bad, people are seeing states reopen, the stock market was doing better. So at the highest interest rate for the 10-year was at about 0.9 something. It ended the day at 0.89 for the 10-year. The 2-year is still down at about 0.2%, and the 30-year is at 1.66%. The Treasury yields kind of caught up to muni yields. The muni Treasury ratio is now back to normal. If you remember back in March, Treasury yields went down a lot and muni yields went up because of the perceived risk to municipalities of the coronavirus-induced recession. Now ratios are back to more of a normal level. The 5 years are at 82%, the 10 years at 98%, and the 30 years at 101%. The municipal calendar next week is expected to be about $7 billion, and that includes both taxable muni bonds and tax-exempt muni bonds. And taxable municipal bonds seem to still be yielding more than corporate bonds, so we at Cumberland see that as an opportunity, not just because of the yield, but because of the better credit quality of municipal bonds. If you remember, for the past few years before the financial crisis, municipal bond ratings have been going up because municipalities have been improving their budgets and reducing their debt. And this is in contrast to corporate bonds that have been increasing their debt for stock buybacks, M&A, and increasing their leverage and getting downgraded. So we see muni bonds as a very good and safe asset class to be in. Now, I have to go back to the jobs report because it's really important. Although the increase in jobs across the board was in most sectors, the one sector where it was down was in state and local government. There was a decline in employment of 585,000. A majority of this was in education, so maybe when schools start up, the employment numbers might look better, but notwithstanding the education, state employment was down over 20,000. And state and local governments were down, local governments were down about 167,000. So this actually is kind of a good thing. People have been worried about municipal credit. They're like, what are the municipalities going to do? They've lost so much in revenue. Well, local governments and state governments have a lot of tools in their toolbox. They can do exactly what they're doing. They can cut expenses by reducing personnel, their largest costs. They can borrow from their rainy day funds, which thankfully they have built up over time. And they have less debt than they did before, so they have some cushion to issue debt to maybe get through some of these humps. And the rating agencies are not dinging municipalities initially for taking some of these actions because it's necessarily required in this situation. The rating agencies and others are going to look to see what these governments do to regain budget balance when things start to recover. So we're going to see a lot of rating changes over the next 2 years because of this, I believe. What's going to happen with the next round of stimulus? There's the HEROES Act out there that has a $3 trillion program, but $1 trillion of that is for some aid for state and local governments. The aid to date has just covered increased expenses, not a loss in revenues. So we'll see what happens now, with the better numbers. Maybe people are thinking, well, we don't need to give more aid, but if you look on the public finance side, the Center for Budget and Policy Center has estimated that state governments are estimated to probably lose from this $650 billion, and the National League of Cities estimates that cities would lose about $350 billion. So that totals about $1 trillion. So we'll see what happens next week with everything that's going on, whether some stimulus gets passed. But overall, the jobs number was good for the economy, and it'll be an interesting week next week. Thank you.